Geopolitical power counts and not economics. The end of the US hegemony and dominance in 2023 and Asia in the new order. Developing nations will eventually overturn the existing world order, forming one in which the US, Europe, and Japan no longer hold primacy. 30 years after the end of the Cold War, a new one is emerging between China and the West, according to leading economists who are trying to predict the trends that will dominate politics and economics in 2023. As an increasingly powerful China seeks to reshape global trade, flows, and international organizations, according to its own vision of the international order, the US and many of its allies face an existential challenge, trying to keep Beijing in agreement with international trade rules and efforts to slow global warming without at the same time ceding ground to democratic freedoms. The key developments. In the distant future, we could see 2022, 2023 as pivotal years. It's pointed out by many sides. So far, we have seen the conflict between the US and the two Asian powerhouses playing out in the open, leading to a self-inflicted energy crisis in the Western alliance. At the same time, a 40-year downward trend is in interest rates ended, replaced by a new upward trend, the full consequences and duration of which are still unknown. The collective West enters the new year with growing fears of a recession. Monetary policymakers face an existential dilemma: prioritize inflation by rising interest rates or lead towards even more monetary stimulus to ensure that financial markets stabilize, their economies don't go into recession, and we don't head into a fiscal crisis. Bloomberg anchor Stephanie Flanders had a conversation with Paul Tucker, former deputy governor of the Bank of England and author of the new book Global Discord, Values and Power in a Fractured World Order. Years ago, world leaders could independently determine their monetary policies, national security policies, and human rights status. But today, these are all intertwined and present particular complications in a world of high political and economic density, the economy. This new reality was evident when the group of G7 economies, in response to the Kremlin's conflict in Ukraine, froze Russian foreign reserves held in Western banks, Tucker says. Changing power relations. Tucker predicts that developing nations will eventually overturn the existing world order, forming one in which the US, Europe, and Japan no longer hold primacy. In this new historical turn, international trade and power balances will have to be completely reformed, but Tucker says that is still a few decades away, because while China is already a global power, India and some other developing nations remain far behind. For now, the US will enjoy a prolonged status quo in global finance as the issuer of the world's leading reserve currency, but in global trade, cross-border investments, and everything else, it will face strong challenge, something of a superpower struggle and a new Cold War, quote unquote. Tucker sees China likely trying to influence global trade and politics much more in the coming years, causing serious turmoil in the West as Beijing tends to prioritize control of the Communist Party over civil liberties. World leaders would have to walk a fine line when dealing with Beijing, he says, working with China on pressing global issues while distancing themselves on others. Tucker says, I think the bigger fact is that China is too powerful for the US and its allies to tell it how to reorganize society, he says. However, the West should find common ground where it can, he points out. The new deals in energy and petrodollars. Economic conditions are quite different in mainland Asia. China is showing the first stages of economic recovery. Russia's economy has not been as badly damaged by sanctions as the Western media would have us believe. All members of the Asian Economic Associations are enjoying the benefits of cheap oil and natural gas from Russia, of course, while the Western alliance is turning its back on fossil fuels. The message sent to Saudi Arabia, the Gulf Cooperation Council, and even OPEC Plus is that their future is Yes to deals with Asian powers, mainly to feed China's massive pedagogic machine. They're abandoning the Western-led Western camp. In 2023, we will see the consequences of Saudi Arabia if Saudi Arabia ends the levy of petrodollars on Western asset markets. The replacement of the dollar after the perfect storm. Energy exporters are turning new trade deals in a bid to replace the dollar. There is talk of a new the new Asian trade settlement currency, but we can expect oil exports to be offset by inward investment, particularly among Saudi Arabia, Asian states such as India, and of course China. The obvious surplus emerging in 2023 is the dollars held as foreign exchange reserves by third countries, whose value is set to depreciate and become an empty shell. It's a perfect storm for the dollar and everyone involved in it, and they'll likely mark the end of Western dominance and the emergence of a new Asian economic dominance. Where next for the US dollar? The threat of interest rates and the currencies of the West. It's a sign of the above how bad the conditions of Western economies have become when interest rates increase of just a few cents are enough to cause a precipitation of a financial crisis, all caused by the evangelists of post-classical macroeconomics, while at first they told every economic orthodoxy that ultimately inflation is transitory. They now admit that the possibility that inflation targets may rise slightly. But the broader concern is that while interest rates have yet to properly reflect the extent of the currency's depreciation, they have risen enough to push the global economy into recession. To their way of thinking, this dilemma is either inflation or recession, not both. A recession is a fall in demand, and a fall in demand leads to a fall in prices, according to macroeconomic orthodoxy. When both inflation and recession coexist, they can't explain it, and it doesn't fit their models. As such, mainstream economists insist that consumer prices will return to the 2% or so target because rising interest rates will trigger a recession and demand will fall. It will take a little longer than they originally thought. They now say the risk is no longer just inflation. Instead, a balance must be struck. Interest rate policy should take into account the growing signs of recession, which means that bond yields should stop rising, and after their previous decline, equity markets should stabilize. For them, this is the way to salvation. Following this reasoning, they succeeded in lowering inflation expectations with the help of weakening energy prices. Since March, West Texas crude has retracted 50% of its March 2020 to March 2022 rally. Natural gas is down 40% from its August high. If the Western media are to be believed, Russia is constantly teetering on the brink of failure, with the suggestion that price normality will soon return, and inflation pressures from rising energy and food prices will disappear. Some of the world's biggest economies hunting for alternatives to the US dollar, lending conditions. What is really happening is that bank credit is now starting to shrink. Credit accounts for over 90% of circulating currency and credit in circulation, and its shrinking is serious business. It's a change in the psychology of bankers, where the greed for lending profits satisfied by the expansion of the balance sheet is replaced by caution and fear of losses, leading to a shrinking of the balance sheet. Although their analysis is flawed, macroeconomists are right to be very concerned. Over 9/10 of US currency and bank deposits are now facing a significant contraction. 9/10. This is a particular problem exacerbated earlier by the COVID lockdown and for businesses affected by supply chain issues. This presents the commercial banks with a huge problem. If they start picking up credit from non-financial firms, they will simply create a corporate financial meltdown that would threaten their entire loan portfolio. What is the key interest rate? Erst, asset management, and the worst nightmare. Central banks see evolving economic conditions as their worst nightmare? Yes, that they are what led to the collapse of the thousands of American banks after the Wall Street crash of 1929-1932. Blaming the private sector for the 1930s depression that followed was directly identified with the collapse of bank credit. Central bankers and Keynesian economists have vowed that it should never have happened. But many point out that we are not just experiencing the end of a 10-year cycle of easing credit conditions, but possibly a multi-decade hyper-cyclical event rivaling the 1930s. And given the tighter coupling of economies today, potentially even worse than that. The upcoming crash. We can easily estimate that if the Fed and other central banks do not relax their restrictive monetary policies, a crash in the markets is certain to follow. And that's what we see when the trend in interest rates began a new upward trajectory last January. For the Fed, preventing a crash is almost certainly a more immediate priority than protecting the currency. It's not that the Fed is prioritizing risks, it's because it can't do both. Their mandate includes keeping unemployment low, and the new Keynesian orthodoxies are also at stake. Consequently, while we can see the risks from credit conditions, we can also see that the Fed and other central banks have prioritized financial market stability over raising interest rates to properly reflect the loss of purchasing power in their currencies. They have no alternative. The policy of persistently higher interest rates must also be temporary. In reality, monetary policymakers have no practical alternative but to prioritize preventing bank credit deflation over supporting their currencies. Realistically, they have no choice but to fight recession with even more expensive money costs, increasing government budget deficits, and through further expansion of commercial bank reserves on their balance sheets. This is the equivalent of quantitative easing. Budgetary deficits. In addition to the central bank's aim to keep bond yields as low as possible, outstanding government budget deficits due to reduced tax revenues and additional spending to deal with the decline in economic activity will also need to be financed. And given the dollar's role in the early stages of a recession, the Fed will likely assume that the exchange rate implications of another round of currency devaluation can be ignored. While currency devaluation is expected to accelerate for the dollar, all other major central banks are expected to cooperate. The business establishment is wrong to think that the choice is between inflation and recession. It is no longer a choice, but a matter of systemic survival. There will almost certainly be a contraction of commercial bank credit and a countervailing expansion of central bank credit. The former leads to a downturn in economic activity, and the latter is a commitment too large for a currency whose supply is growing rapidly. The unpleasant truth for neo-Keynesians is that monetary stimulus policies always end up impoverishing everyone. The role of credit and the final solution. To clarify how events are likely to unfold in 2023, we need to review the basics of monetary theory and the difference between money and credit. It's a persistent downgrading of the latter that has been the problem and is likely to condition the plans of any country seeking to escape the monetary consequences of the shift in global hegemony from the Western alliance to the Russia-Chinese partnership. It's probably too late for any practical solution to the policy dilemma facing monetary policy committees in Western central banks today. When commercial bankers are collectively awakened to the lending risks largely created by their earlier optimism, survival instincts are heightened, and they will reduce their exposure to risk whenever possible. The consequence is a credit cycle of booms and busts. Inevitably, in the collapse phase over leveraged banks fail, while the intention is to smooth out the cyclical effects on the economy. The reaction of the state and its central banks always makes things worse by undermining monetary policy. The leverage of asset indices. It's important to appreciate that with a healthy monetary system, which is a currency that changes in quantity only at the behest of its users, excessive credit expansion should be discouraged. The opposite is encouraged by central banks. The extreme leverage of asset to equity ratios for systematically important banks of more than 20 times in Japan and the Eurozone is solely due to central bank policies to cut interest rates. Only with extreme leverage can commercial banks, which are nothing more than credit traders, profit from tighter credit spreads when zero and negative deposit rates are imposed on them. Column Bank of Japan stocks. The influence of the commodity market. After lowering interest rates to zero and below, increased interest rates are finally imposed on the monetary authorities by the markets. Rightly so, it's become fashionable to describe the developments as an evolution of monetary environment driven and dependent on financial assets to a commodity-driven environment. In the words of Zoltan Pozsar of Credit Suisse, Bretton Woods 2 is ending and the Bretton Woods 3 is upon us. For this reason, there's growing interest in how a new monetary order based in some way on commodities or commodity-based economies will evolve. This year, Russia has successfully protected its ruble by pegging it to energy and commodity exports, undermining Western currencies in the process. Gold reserves? While it's always wrong to predict the timing, the fact that no one in financial establishment is discussing how to use gold reserves to protect their currencies clearly indicates that we are still in the early stages of developing and looming currency crisis. Officially, at least, those planning a new pan-Asian trade settlement currency, an alternative to the dollar, are trying to back it with commodities rather than gold. Since Sergei Glaziev researched the topic, the Middle East shift from a petrodollar to Asian currencies not only introduces a new dimension of urgency to the debate, but is sure to have a significant impact on its outcome. Implications for the Western alliance play no role in current monetary policies. Their central banks act as if there is no risk to their own currencies from these developments. However, any doubt that fiat currencies will be replaced by currencies linked to tangible commodities, whether represented by gold or not, fades in light of developments. So we're going to see a lot of changes, aren't we? This is by Banking News. I've translated this for you from a Greek article. Please leave your comments. Thank you for your support. Kindly support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support and that you find all my content so interesting. You'll find the Patreon account details in the description box.